Have you ever felt like you're walking on thin ice, especially when it comes to your investments? That feeling of uncertainty, that nagging doubt, it's something every investor knows intimately. Benjamin Graham, the father of value investing, offered a solution: the margin of safety. It's the bedrock of prudent investing, a buffer against the inherent risks of the market. But what happens when the ice gets thinner, when the market becomes a whirlwind of information, a tempest of volatility? Can the old rules still apply? That's the question we're tackling today. The world has changed dramatically since Graham penned The Intelligent Investor *. We are bombarded with data, news cycles spin faster than ever, and the market seems to defy logic at every turn. The traditional margin of safety, while still relevant, needs an upgrade, a modern adaptation. It needs to evolve to meet the challenges of today's complex financial landscape. We are not just talking about theoretical concepts. We are diving deep into practical, actionable strategies that you can implement right away. Forget the surface-level analysis and the generic advice. We are uncovering the hidden truths behind value investing, the nuances that separate the successful investors from those who are simply gambling. This isn't about blindly following the herd. It's about developing a critical, independent mindset. It's about understanding the why behind every decision, not just the what. Over the next few minutes, we'll explore 6 hidden strategies that will enhance your margin of safety, providing you with a robust framework for navigating the modern market. Consider this your critical investor's guide, your compass in a sea of financial noise. Challenge the consensus, find your edge, and let's begin building a more secure and prosperous future together. Are you ready to see investing with new eyes? How often have you heard someone say a company has a great economic moat simply because of its well-known brand? It's a common refrain, but is it enough? Is brand recognition alone a sufficient defense in today's hyper-competitive landscape? The truth is, many investors stop at the surface, relying on qualitative assessments that lack real substance. They see a popular brand and assume it's impenetrable. But what if that brand is losing customers, facing increasing competition, or struggling to maintain its pricing power? That's why we need to go beyond the superficial and delve into the quantifiable aspects of competitive advantage. We need to look at metrics like customer lifetime value, that is, how much revenue a customer generates for a business throughout the relationship. We need to analyze churn rates, the rate at which customers discontinue their relationship with a business. And we must understand switching costs, the expenses a customer faces when changing to a different supplier. Let's consider 2 companies, one with a flashy brand but weak customer retention, and another, perhaps in a less glamorous industry, but with incredibly sticky customers and high barriers to entry. Which one truly possesses a stronger economic moat? We'll dissect how to calculate and interpret these metrics using publicly available data, offering you a step-by-step framework for assessing a company's true competitive strength. You might be surprised to discover that the most robust moats aren't always found in the most exciting industries. Sometimes the real value lies hidden in the mundane, in the companies that quietly dominate their niche with unwavering customer loyalty and defensible competitive advantages. Are you ready to dig deeper? How confident are you that you're seeing the full picture when you analyze a company's financial statements? Are you certain that all the liabilities are truly visible, or could there be hidden debts lurking beneath the surface, waiting to sink your investment? Traditional financial statement analysis can be a useful tool, but it often falls short in uncovering sophisticated accounting tricks and off-balance sheet liabilities. Companies can cleverly conceal debt through various methods, creating a distorted view of their financial health. That's where forensic accounting comes in. This involves a deeper dive, a more critical examination of the financial statements, including those often overlooked footnotes. We need to scrutinize related party transactions, those deals between the company and its executives or affiliates, and assess contingent liabilities, potential obligations that may arise in the future. Consider a company that used off-balance sheet entities to hide massive amounts of debt, creating an illusion of financial stability. When the truth was finally revealed, the consequences were devastating for investors. What are the red flags to watch out for? Be wary of aggressive revenue recognition. When a company prematurely records revenue, scrutinize high levels of accounts receivable, which could indicate difficulty collecting payments, and pay close attention to any unexplained changes in accounting policies, which could be a sign of manipulation. The most empowering tip I can give you is to develop a healthy dose of skepticism. Don't blindly accept management's narrative. Question everything, dig deeper, and always be on the lookout for hidden debts that could jeopardize your investment. Are you willing to challenge the numbers? How much of your investment decisions are driven by logic, and how much by emotion? We often think of the market as a rational entity, but the truth is, it's heavily influenced by human psychology, by our biases, our fears, and our desires. True value investing goes beyond simply identifying undervalued assets. It requires a deep understanding of the psychological biases that create and perpetuate market inefficiency. inefficiencies. These biases can lead to irrational behavior, creating opportunities for those who can remain calm and objective. Let's consider a few key biases. Anchoring bias, the tendency to rely too heavily on the first piece of information received. Confirmation bias, the inclination to seek out information that confirms our existing beliefs. And loss aversion, the pain of a loss being psychologically more powerful than the pleasure of an equivalent gain. Imagine a company that experiences a temporary setback, triggering a wave of negative sentiment and market panic. Many investors, driven by fear, rush to sell, driving the price down far below its intrinsic value. This is where the behavioral value investor steps in, recognizing the irrationality and seizing the opportunity. We can use contrarian indicators such as put-call ratios and investor sentiment surveys to gauge extreme market pessimism. These tools help us identify when fear is at its peak, signaling a potential buying opportunity. Remember, the greatest opportunities often arise when others are most fearful, but capitalizing on these opportunities requires emotional discipline, the ability to resist the urge to follow the crowd, and to remain confident in your analysis. Are you ready to conquer your biases? How much attention do you pay to a company's capital allocation decisions? We often focus on stock picking, on identifying undervalued companies, but we often overlook the critical role that management plays in creating long-term value. Capital allocation, the way a company chooses to deploy its capital, is one of the most important drivers of shareholder returns. It's about more than just generating profits. It's about how those profits are reinvested, distributed, or used to acquire other businesses. We need to analyze key metrics such as return on invested capital, a measure of how efficiently a company generates profits from its capital. We need to examine the dividend payout ratio, the percentage of earnings paid out as dividends. We need to assess the effectiveness of share buybacks and scrutinize a company's acquisition history. Consider two companies in the same industry, one with a management team that consistently makes smart capital allocation decisions, reinvesting profits wisely and generating high returns, and another with a team that squanders capital on poorly performing acquisitions or excessive dividends. Which company do you think will deliver better returns over the long run? We'll explore how to assess management's track record, their alignment with shareholder interests, and their long-term vision for capital deployment. You might be surprised to learn that a mediocre company with exceptional capital allocation can outperform a great company with poor capital allocation over the long run. It's a hidden truth that can significantly impact your investment success. Are you ready to master capital allocation? How often do you consider a company's potential for future growth beyond its current operations? Traditional valuation models often focus on existing assets and cash flows, but they struggle to capture the value of future opportunities that may not be immediately apparent. That's where the concept of optionality comes in. It's about assessing a company's potential to expand into new markets, develop new products, or leverage its existing assets in unforeseen ways. It's about recognizing the hidden growth potential that lies dormant within a company. Consider a company with a strong research and development pipeline, a flexible business model, and a history of successful innovation. These are all indicators of significant optionality. The company may be currently undervalued by the market due to its focus on core operations, but its potential for future growth is immense. We'll explore how to identify these key indicators and assess a company's potential to create value through optionality. Investing in optionality requires patience and a willingness to look beyond current financial performance. It's a long game, but the rewards can be substantial. It's about recognizing that the future is uncertain, but that some companies are better positioned to capitalize on that uncertainty than others. Are you ready to embrace the power of optionality? We've journeyed together through the often overlooked corners of value investing, uncovering strategies that can significantly enhance your ability to generate sustainable returns in today's complex market. From deconstructing economic moats to mastering capital allocation, we've explored the nuances that separate truly insightful investors from the rest. It's crucial to remember that these 6 hidden strategies are not standalone tactics. They are interconnected components of a holistic investment approach, a framework that requires both intellectual rigor and emotional discipline. They demand a willingness to challenge conventional wisdom, to dig deeper than the headlines, and to remain steadfast in your convictions even when the market is telling you otherwise. Adapting value investing principles to the modern market environment is not about abandoning the wisdom of Benjamin Graham, but about building upon it, about recognizing that the world has changed and that our strategies must evolve accordingly. It's about adding layers of sophistication, incorporating behavioral insights, and developing a more nuanced understanding of the forces that drive market behavior. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This simple statement encapsulates the emotional intelligence needed to implement these strategies effectively. It requires the ability to resist the siren song rung of the crowd, to remain calm and rational in the face of market volatility, and to seize opportunities when others are paralyzed by fear. As you move forward on your investment journey, let these hidden strategies serve as your North Star, guiding you towards sustainable success. Embrace the challenge, cultivate your critical thinking skills, and never stop learning. The path to financial mastery is a continuous process of growth and adaptation. Are you ready to navigate the market with newfound confidence and clarity?